Today, we're diving into some of the most pressing questions facing the markets as we head into 2025. Are they really doomed?
With insights from top experts including Joe Quinlan from Bank of America and Mitch Vexler, you're in for a treat.
Imagine distilling hours of complex analysis into just minutes. That's exactly what we're doing today.
And trust me, you won't want to miss the surprising insights we have in store for you.
But before we dive deeper, let's clarify. This video is for educational purposes and isn't specific investment advice.
Now, let's jump into our first segment with Michael Beatties and see how tariffs are reshaping our economy.
Today's discussion focuses on the potential implications of the trade war, inspired by Michael Beatties, a specialist in global trade.
Beatties argues that tariffs could actually boost U.S. GDP and employment, an interesting perspective against free trade assumptions.
According to Beatties, the incoming Trump administration may embrace tariffs, believing they could enhance the U.S. economy.
It's fascinating, especially since we usually associate tariffs with negative outcomes for free trade. Beatties references David Ricardo's comparative advantage theory, illustrating why countries trade.
So, while theory says trade is always good, how does it hold up against current realities?
Beatties points out the problematic chronic trade deficits that the U.S. has.
It's like a one-sided partnership. How can that work?
Beatties argues that implementing tariffs could actually make U.S. manufacturing more competitive.
I see. So it's like pushing a struggling athlete to train harder.
Beatties predicts that tariffs will not only be used for negotiations, but will become a permanent feature.
That's quite the shift. It could redefine U.S. trade relations.
The insights from Beatties remind us that trade is far more complex than it appears.
Indeed, it highlights how government intervention can influence entire economic landscapes.
In today's analysis, we're diving into the 2025 economic outlook with Mitch Vexler, an expert frequently featured on Zero Hedge.
Mitch will share insights on inflation, the bond market's effect on mortgage rates, and the future of the housing market.
Mitch argues that inflation is likely to persist around 3%, which directly influences interest rates.
What implications does that have for homebuyers?
Exactly. Affordability challenges could continue to hinder the housing market.
Mitch notes how volatility in the bond market directly determines mortgage rates.
Is that contributing to the reluctance of potential homebuyers?
Indeed, higher costs are influencing buyer sentiment.
Mitch points out that market perceptions often misalign with the experiences of families.
Many people are trapped in debt, yet expected to buy homes.
There's a strong link between financial literacy and informed purchasing choices.
Good financial advice is essential for buyers today.
Mitch predicts that economic challenges in 2025 could lead to increased foreclosures.
And high prices will continue to be a barrier to affordability.
However, informed and patient buyers could find opportunities.
The main takeaway today is that success in the housing market requires knowledge and patience.
Absolutely. Understand the numbers and market dynamics to thrive.
Today, we're diving into an eye-opening analysis by Jeff Snider on the situation with China's banking system and currency.
Snider points out that the recent sharp drop in the yuan indicates a troubling shift in financial stability.
According to Snider, the yuan's plunge, falling below 7.32 to the US dollar, is a red flag for economic stability.
Indeed, he emphasizes that the current situation reflects deeper structural issues within the banking system.
Snider emphasizes that the yuan's decline reflects a loss of trust in the banking system.
And he argues that government interventions are becoming more evident as authorities attempt to stabilize the currency. Snider paints a bleak picture. Banks are lending primarily to state-owned firms, leaving little room for private sector support.
This appears to be a major paradigm shift. If banks can't lend effectively, how can the economy recover?
Snider warns that we haven't seen a full-blown liquidity crisis yet, but signs of irregularities could indicate trouble ahead.
This reveals a fragile system, very different from how China historically rebounded.
Snider foresees that if banks persist in withholding credit, we might witness a liquidity crisis.
Given the government's slow response, the situation necessitates careful monitoring.
Snider's insights highlight the interconnectedness of global finance and the implications of a weakening banking system.
It's crucial for investors and stakeholders to remain aware of these evolving dynamics.
Today, I'm thrilled to welcome back Doomberg, the renowned energy expert, to discuss the upcoming energy boom in the U.S. and its potential impact on the economy as we head towards 2025.
Thanks, Adam. It's great to be here again to discuss such an important topic. Energy is indeed the lifeblood of the economy.
Doomberg points out that the natural gas market has undergone crucial changes. Prices spiked due to increased demand and supply constraints.
Absolutely. The disparity between oil and gas prices has widened dramatically, especially with engine switching trends emerging globally. Doomberg emphasizes that OPEC's strategy for keeping oil prices high is losing effectiveness, which benefits natural gas production.
So with OPEC losing its influence, can we expect energy prices to stabilize?
That's the hope, but market fluctuations are always a possibility.
According to Doomberg, natural gas will be critical for meeting rising energy needs, especially as technology advances.
Right, and he forecasts that natural gas will be essential for powering innovative technologies. Doomberg indicates that America's vast natural gas supplies provide a strategic economic advantage.
But are there potential risks with this strategy? What if energy prices rise?
That's definitely a concern, especially considering inflation risks.
Looking ahead, Doomberg predicts a massive transformation in the energy sector, driven by policy changes and technological advancements.
How do you see global politics influencing these trends?
Political stability and supportive policies will be essential for effectively harnessing energy resources. Doomberg believes the U.S. is on the verge of a significant energy resurgence contingent on political stability.
What happens if political support for this boom falters?
Failure to support this could lead to delays in growth and innovation.
In conclusion, Doomberg's insights indicate that the future of U.S. energy is heavily influenced by market and political factors.
Exactly. Successfully navigating the path to energy abundance involves both opportunities and risks requiring careful consideration.
Today, we're diving deep into economic forecasts with Joe Quinlan, head of market strategy at Bank of America.
Joe discusses the outlook for stocks, inflation, and consumer spending as we approach 2025.
Joe Quinlan's thesis suggests that despite economic headwinds, there is optimism for market recovery.
He emphasizes that with a strong consumer base and effective policies, we could see encouraging growth.
Quinlan indicates that while inflation remains a key concern, the strong performance of high-income consumers can help sustain economic growth.
That level of spending could significantly influence how markets react, especially if inflation continues.
Quinlan sets a year-end target for the S&P 500 at 6,666, anticipating strong earnings and growth.
It appears optimism is strong. Will it hold true amidst any consumer pressures?
Joe elaborates that tariffs can have targeted impacts, especially on industries reliant on imports from specific countries.
Could these tariffs potentially backfire, leading to higher prices for consumers?
Quinlan predicts that stable consumer spending may help keep markets buoyant.
But if policy changes unfold too slowly, that might pose risks for investor sentiment.
Quinlan's insights remind us that flexibility in investment and consumer habits is key in navigating the evolving economic landscape.
Ultimately, it's a balancing act between optimism in market recovery and recognition of the risks.
Today, we're summarizing Matt's analysis from the Trade Brigade Weekend Show regarding the failed Santa Claus rally and what it might mean for 2025.
Right. Matt mentions that the failure of this rally ruins the first part of the January trifecta, suggesting that we might see only single-digit returns next year.
Matt articulates that the Santa rally's failure means we should brace for possibly disappointing returns next year.
He argues that if the December low is breached, there's about a 50-50 chance that 2025 will close in the red.
Matt notes that the failure of the Santa rally disrupts the January trifecta, traditionally seen as a bullish sign.
So does that mean investors should be more cautious now?
Absolutely, according to Matt. A failed Santa rally often leads to less confidence going into January. Matt emphasizes that keeping an eye on the December low is crucial. If broken, the market outlook for 2025 could turn quite grim.
So if that level dips, that's a major red flag for investors.
Exactly. Matt rates the risk as 50-50 for seeing a down market if that low doesn't hold. Matt suggests that if the December lows hold, we may have a shot at stable returns.
But there are also big risks if we start breaking down, especially with looming inflation concerns.
Matt highlights two potential scenarios for 2025: best case stabilization and worst case prolonged downturn.
What does that mean for average investors? Should they just sit and wait?
Matt advises cautious strategies, particularly watching the levels he discussed.
In conclusion, Matt's analysis reminds us that market trends require vigilance, especially watching the December low.
It's about being proactive and adjusting strategies in response to shifting market dynamics.
What an incredible lineup of insights we had today.
Indeed, Matt's analysis of market trends post the Santa Claus rally was particularly thought-provoking.
Absolutely. And Joe Quinlan's blend of optimism and caution set a great tone for discussing inflation.
Plus, Doomberg highlighted the energy boom, which could really impact economic growth moving forward.
And then Jeff Snider brought a sobering perspective on China's financial stability. Very compelling.
Right? And the differing views on trade policy from Michael B's suggest a complex future ahead.
We noticed a clear agreement on the interconnectedness of consumer behavior and economic conditions.
But the debates around timelines for recovery and influences on the economy were fascinating, showcasing a spectrum of perspectives.
If you enjoyed these insights, remember to like and subscribe. Your support means a lot to us.
Absolutely. It helps us keep bringing you the best expert analysis out there.
Don't forget to check out our next video on the evolving landscape of global trade.
You definitely won't want to miss it. Until next time.